Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. The countdown begins with Wall Street now eagerly awaiting Nvidia's earnings results. We have full coverage of everything you need to know. We're talking directly with CEO Jensen Huang in a not-to-be-missed interview. That's at 6:30 p.m. Eastern Time. And right now, there's just an hour to go until the closing bell. Stocks, they're moving higher. The Dow, you're up about 183 points. Your broad gauge, the S&P 500 is up about 0.3%. Your tech-heavy NASDAQ is up about 0.2%. By the way, the Russell 2000, your small caps, they're tacking on another 0.6% here. Let's welcome in tech editor Dan Howley and our data and markets editor Jared Blickery. They're going to be joining us throughout the show to break down all the headlines. Jared, my friend, I'm going to start with you on today's trading action.
That's right. We got the markets in rally mode. It's not a huge one, but I think we'll take it, especially for this low volume, low volatility time of year. Dow Industrial's up 178 points, or about 0.4%. And you can see now we are at the highs of the day. So it's been a pretty green day for us. Looking at the NASDAQ composite, we're in the red a little bit of the day, but up at 20 basis points or so there. And the S&P 500 up just a smidge more than that, and that's after opening just slightly in the red. And I do like to take a look at the small caps. Russell 2000 also at the highs of the day, up the most, 2/3%. And just taking a look at the bond market, kind of a split market here, we see the 10-year going down 2 basis points to 4.24%, and the 30-year going the opposite direction, although just barely. That's almost break even, 4.91%. And let's take a look at the sector action. A lot of green, not a lot of red. That's what we like to see. Only healthcare just barely in the red now. Had been more of a defensive play, and that was looking green last week, but not today. Energy is the best off today, up 1.33%, followed by real estate, tech, and financials. All of those outperforming the S&P 500. And let's take a peek inside the NASDAQ 100 here, where you see a lot of green, especially in some of the mega caps, not Meta and Tesla, but we are seeing not outsized gains, but Broadcom up 0.8%, Microsoft there just with it, and Apple up about 0.3%. And taking a look at the chip stocks, these have been flying high recently. Not some huge flyers here. Intel clawing back some recent losses, up 2%. Micron up 1.4%. And we'll take a look at software, which hasn't fared the best over the last few days. But today we do see some dark green. Salesforce up 2%. ServiceNow up 2%. S&P just right there with it. Datadog up 3.4%. And let's take a look at the Dow here. And we see a lot of green as well. We just covered Salesforce. We also have IBM in the green. Chevron, that's that energy leader that we saw. And I'm going to close with retail because that is one of the sectors that has been reporting recently. So we do see Target here up over 1%, Ulta up over 1%, Dollar Tree up over 1%. A lot of these smaller issues are reporting right now. So that's kind of what we're looking at. Of course, the big show with Nvidia later. I'm sure we got more to talk about on that front.
We sure do, Jared. Thank you, sir. Dan, the moment we are waiting for, my friend, what are the Nvidia fundamentals investors should be looking for in your opinion? And what can we expect from the earnings call?
The big thing here is obviously going to be data center revenue. I mean, you know, that might as well just be stamped on everyone's forehead as the most obvious thing in the world. But I think within that, what we're going to be looking for, what I'm going to be looking for, is the percentage of data center revenue that comes from the hyperscalers, the Microsofts, the Googles, the Amazons, the Metas, I almost said Facebook, the XAIs. Mm-hmm. They're buying, tens of thousands of these chips, and that's helping to bolster NVIDIA's revenue big time. I think during the last quarter, it was just slightly less than 50% of total data center revenue. So that's huge. I think that's going to be one of the things to look out for. Are they still leading as far as the revenue percentage goes? Are they relying less on that? Are they getting more revenue from this idea of sovereign AI, where countries build out their own data centers, and so they use chips like NVIDIA's? Mm-hmm. That's going to be something that's definitely worth following. Also, obviously, everybody wants to know about China. One of the things that I think is interesting is that, China makes up a small percent of their overall revenue, but it's taking up a lot of the oxygen in the room when it comes to this earnings report. So, where is that revenue going? How much is from China? When will the new chips start shipping there, those Blackwell-based chips? when will they start to report revenue on that? And then the other thing I just want to point out is Blackwell Ultra. That's their next generation chip. Vera Rubin, their next generation chip. So when are we going to start to see the ramp in Blackwell Ultra? When does that start to show up on the earnings sheet? And then obviously, I personally just want to know about gaming revenue. That's,
You know, that is what, by the way, when we used to talk about Nvidia earnings, we would make a beeline for that.
Oh,
it was
yeah.
gaming and crypto.
Oh, yeah.
That was it.
Mm-hmm. And, you know, look, gaming is still a huge part of their business. Relative to data center, it's not huge. We're expecting about $3.8 billion, I think, for this quarter. I'll take $3.8 billion.
Yeah.
But, you know, one of the things that's interesting is we're seeing these kind of tariff-related, or as the companies are calling it, economic situation, circumstance-related issues with pricing of different game consoles. Sony raised the price on their PS5, Xbox, Microsoft raised the price on that. Nintendo, oddly enough, raised the price on their original Switch, not their new Switch, the Switch 2. What's important to that is that's outselling the original Switch. The chip that powers that, an Nvidia chip. So I want to know what that does for Nvidia's bottom line in that gaming segment. And then are they seeing any kind of issues with regards to their own hardware in the US, sales in the US and abroad? Are people cutting back on spending on that? You know, obviously they're expensive chips. You know, they can be hundreds of dollars. You know, are people holding off in this kind of economic climate that we're seeing? Or do they say, hey, look, this is a long-term investment. When you have these cards, they can last 5 years. Are you just going to say, let me just dump the money now, have this for 5 years, and then I can just keep, you know, playing games and, you know, whatnot for the next few years, not have to worry about it. So that's going to be something that I'm particularly interested in. Very selfish of me, though.
Selfish is okay. Expectations, we should note, kind of hot. I mean, you're running into this, right? This stock is up more than 30% since the last time they reported.
Yeah.
In terms of their competitive position in the broader market, Dan, would you say there's been any kind of material or meaningful change there?
No, I think, you know, honestly, AMD has their new chip coming that is supposed to compete with Blackwell, but then they're going to be on Blackwell Ultra. So they're going to be a step ahead of AMD as far as that goes. But, you know, sure, their hardware is great. You know, companies can look at their hardware and you know, try to ape it almost, right? But I think the big thing is obviously their software, CUDA, and that gets people locked in. And so it's the same idea where, you know, I bought all my apps on my iPhone, so I'm not going to switch to Android because all my apps are over here.
Yep.
Companies build on CUDA, and then they say, well, I'm not going to switch. I just built my apps on CUDA. Why
locked in now.
Right. So that's a big part of what keeps people coming back to Nvidia. Plus, the CUDA software is just generally good, and so you know, AMD is working on their own. They're, you know, obviously they have their own, but they're continuing to build it out and deploy it. But I think that's really what keeps Nvidia on top at this moment. And there's still demand, right? We talk about China; they weren't able to sell, but there's still demand. That H20 chip, not as powerful as any of the Blackwell chips. Companies are still sucking them up over there because they want access to Nvidia's ecosystem.
Big afternoon for Dan Howie. Big evening, afternoon, evening, long night. Thank you, Dan. Stay tuned for our live coverage of Nvidia's second quarter earnings report to start at 4:15 p.m. Eastern. And you won't want to miss our interview with Nvidia CEO Jensen Huang. Tune in at 6:30 p.m. Eastern. Well, the White House turning up the heat on Fed Governor Lisa Cook, pressuring her to step down from her position. President Trump's top economic advisor, Kevin Hassett, told reporters Cook should take leave right now, calling it the, quote, honorable thing to do. Trump sent a letter to Cook Monday saying she was fired effective immediately, citing allegations around 2 mortgage applications. Cook mounting a legal defense. And join me now to talk about this. We have Eric Rosengren, former president and CEO of the Federal Reserve Bank of Boston. Eric, it's good to see you. So, you know, let's start on the news, Eric. So Trump fires Lisa Cook. She obviously shoots right back, says she's not going anywhere. Where do you stand on this, Eric? What's your response?
Right now, we don't have very many facts. So we have an allegation by tweet, but we really don't know any of the details of why she had 2 homes and what exactly was happening with the purchases. So I think at this stage, we should not draw any conclusions. And unfortunately, we're probably not going to be able to draw any conclusions until it gets litigated in court. That's not likely to happen for some time.
Do you think, Eric, to your point, we don't know a whole lot, and there's some really basic questions folks have right now. Is Lisa Cook at work? If she tried to go to work, would she be allowed into the building? I mean, I just think as citizens and investors, lots of basic stuff being asked. I just wonder if you think Lisa Cook as a public official, does she have a responsibility, Eric, to come out right now and say, listen, this is what happened, this is why it happened, this is the story?
I mean, right now we just have an allegation. I think she's waiting for there to be a fact finding either at the Fed or through a judicial process, and that trying this in public does not make sense.
Is this a threat to Fed independence, Eric, this feud we're seeing play out?
Obviously, it's an attempt to change the monetary policy that have been followed over the last year by the current FOMC. So the president's going to have an opportunity to appoint somebody, and if Lisa leaves, it'll be two somebodies. That can start changing what the nature of the policy is. And the administration's made it clear that they want interest rates much lower. So if you start setting interest rates by what the president wants rather than what you think is appropriate for inflation and unemployment, you're now with a Fed that doesn't have independence, and that's a very different situation than we've been in the post-war period.
Eric, there's another thread to pull on here, and that's the regional presidents. Their terms expire in February. They need to be renewed, correct? So what do you think happens there? How would you guess that shakes out?
So the Board of Governors is the one that has the final say in the president's being renewed. And until we know what the composition of the Fed's going to be in February, it's a little bit hard to handicap. My guess is that Lisa Cook is still at the Fed at that time, that things won't have been resolved by then. And I doubt that it'll be as substantial as some people in the markets have been worried about.
More broadly, Eric, let's move on here. I'm curious to get your take on the U.S. economy, Eric. Where do you think we are now, and where do you think we're headed?
We're in a situation where inflation's running just around 3%, which is a percentage point above the inflation target. The economy definitely has slowed. We'll be getting some more information both on inflation and in real GDP later this week, but it looks like we basically have an economy that's growing around 1.5%. I'm expecting that to continue, and that will probably continue to have inflation trending a little bit over 3%. So under normal circumstances, it wouldn't call for a substantial easing. What's being suggested by the administration is probably not what would happen without some change in the composition of the committee.
Eric, I think the investors listened to Jay Powell in Wyoming on Friday, and I think they heard a policy pivot. Do you think that cut is coming in September?
It certainly left the door open for a cut, but we still have some more information before the September meeting. If the inflation numbers ended up being higher than people expected, and the labor market doesn't look as weak as the last labor market report, most of the reaction to why people expect September easing is because we had a pretty weak payroll employment, but it is only one number. So until we have those numbers, I don't think we'll have a good idea of whether it'll definitely happen. But the chair certainly left it open that it could happen.
Sure did. That's how investors saw it. Eric, good to see you as always. Thank you, sir.
Thank you.
We are just getting started here on Market Domination. Coming right up, Nvidia is king when it comes to chips and big tech right now, but we're talking to one strategist what other plays to watch out for in the space. And you won't want to miss our interview with Nvidia CEO Jensen Huang. Tune in at 6:30 p.m. Eastern. Plus, Cracker Barrel rolls back its modernization push. We're taking a deeper look on whether the news is good for business. And a not-so-sweet note for Krispy Kreme. We're looking at why shares of the donut maker are sliding here. Those stories and more coming with us. From the Fed's latest signals to the AI chip boom, markets may be caught between policy risk and tech optimism. Let's bring in Ben Emons of FedWatch Advisors for a look at where investors should keep their focus. Ben, great to see you as always. So let's start off with the Fed feud, Ben, because Trump says he's firing Lisa Cook. Lisa Cook hits right back, says she's not going anywhere. The stock market seems to be shrugging this off, Ben, but you see Fed risk rising in Treasuries. Walk us through it.
Yeah, if you kind of look at the yield curve today, it's only getting, like we would say, steeper. In other words, it's really like long-term interest rates are rising with a little bit of short-term rates falling, discounting these rate cuts. And I think there's two things happening there. One, it is probably somewhat of a reaction to this change that's happening in the Fed currently. Now, if Lisa Cook is not coming back, we have 2 open seats on the board going into the September meeting, which could be kind of a contentious meeting because this rate cut is on the table. We had Williams today out talking about it too, another signal that it's likely to lower rates, but there's also a whole group of others there that are dissenting potentially against it. So there's a bit of that type of risk of like, will the Fed or will they not cut, that sort of whipsaw idea. Plus, if you cut rates and you're going to cut rates more, and we're in an economy that's already showing some signs of reacceleration coming through the summer. There's different data out now from housing and retail and PMI data, and you cut rates, you can give the economy the swing, so you could actually get a little bit higher rates as a result. And I think that's what I call the Fed risk priced into the yield curve. The stock market likes it because like rate cuts are like strong economy.
So in other words, risk assets say, hey, let's stay focused on the fact that we're getting cheaper money.
Yeah,
Yeah.
get cheaper money, lower rates, but also stronger economy. That's likely of that because we're not like a weak point here. We just had a little sluggish period because of the tariff uncertainty that's faded away. We're actually coming alive again while you're going to cut rates. So I think those are the two things playing. Who knows how this will play out with Cook? We don't know, right? But in the end of the day, the Fed is changing. It's going to be a different FOMC, likely more conducive to lower rates, even lower rates. So that too, if that's the case, long-term rates are likely going to rise. That's, I think, the Fed risk.
Let me ask you. So we have one theme, the Fed, front and center. We also have Nvidia earnings on deck after the close today. What is more important, Ben? Is it the Fed? Is it the Trump-Cook drama, or is it this great AI trade and trend?
Yeah, it's the AI trade in my view.
Why, Ben? Why do you say that?
Yeah, well, one, it has obviously a major effect on the markets itself. I mean, Nvidia being 8% of the S&P, that's a big weight in the S&P itself. So it's a kind of a sigma event, as we would say. You know, there's that volatility moment potentially. But what it actually signifies is that as Nvidia continues to generate these massive earnings, because of the demand for chips and AI, and we're about to spend even more on AI, plus investing in AI, because the countries that have committed to the US to invest in the US, Qatar and UAE and a couple others, it's all AI driven. I think that's really what the Nvidia earnings are truly all about, is that this is an economy driven more and more by AI investment. I think that's why it matters more than what's happening with the Fed, meaning the legality issues there, other than the rate cuts, obviously, which can affect the economy, but it's the Nvidia earnings and the investment in the AI, that's what matters.
All right, so no pressure on Jensen Huang, just the stock market on his shoulders. That's what we're saying at this point.
Yeah, I think that, I mean, they could disappoint, right? That there could be some number in there that will probably be a miss or disappointment or not meeting the expectations exactly. So we'll see volatility in the stock, you know, as the numbers come out. But if you step back from it from a macro perspective, this is about investment now of AI. We had a lot of spending, but this next stage of this investment, I think that really is what key here, because this commitment that's made by countries and companies, that's trillions of dollars. I take President Trump really serious on this. He's going to go after those countries to make sure that it actually gets invested. I think that's what markets are sensing, that that's going to happen starting this quarter. So these earnings could maybe give us a little bit of a cue on that too, what's happening with that exactly.
Let me ask you a broader question, Ben. You look at this market and the big move we've had off that April low. I'm just curious what you're hearing from your clients. I mean, do you hear them being generally confident? Are they cautious? What's the tone?
Well, there was a lot of worry about tariffs for some time and how this would be globally negative and inflation and that sort of thing, but that's really moved away. It turned out that the tariffs are well absorbed on either side of the pond, so to speak, the exporter and the importer, and not really passed on much anywhere.
Now, there's some, Ben, I have economists on the show, though, who tell me, just you wait, that pain is coming. Don't pop that champagne cork just yet.
I can't fully disagree with that, because it's true, because there's some lagged effect. But I think we can take from markets, and that's what my clients are saying, is like, these financial conditions are getting only looser in an economy that's picking up, where Fed is going to likely lower rates, whether it's politically driven or driven by the idea that tariffs do not impact inflation so significantly, then it's all about a risk-on environment, which means what's really on people's mind is that, are we back to 1999 and we're going to see suddenly this accelerated upside in the NASDAQ and other equity indices as all this investment in AI really comes online and people start discounting next scenarios of like where this market could be going, meaning S&P 7,000, 10,000, right, that sort of thinking. I think this is what it looks like. Despite all the froth and overvaluation, people are very much looking at upside rather than downside risk.
I had a strategist yesterday, Ben Doe, tell me. I was asking him, he's a longtime market watcher like you. I said, what do you think the biggest risk is for the market? And we were talking AI, valuation, sentiment, positioning. He told me, I think the biggest risk, he says, is that between now and the September FOMC meeting, the Fed sees more data on jobs, inflation, and think, you know what, actually, I know maybe you heard us say there's a policy pivot coming Jackson Hole, but no cut. He thought that was the biggest risk. What do you make of that?
Well, it's not unrealistic that way because it's so priced in and it's so like signaled now. And Powell did it now today. Williams did it, which is important, right? Because Williams is an important person in the FOMC. He's a centrist and big role. So yes, if they decide not to cut, it would lead to a political issue, but it also leads to market expectations starting swinging completely the other way, thinking, okay, this economy is already taking off, it's getting too strong, and rate cuts are not necessary. In fact, we have to keep policy more restrictive, and the stock markets would then sell off on that, quite likely, because there is rate cut speculation priced into the stock market. The small caps are the clear evidence of that, right? They're very sensitive, and the banks obviously. So I don't disagree with that view, but I would more think of like other risks that are really there are just really this economy surprising really to the upside, like as in we're getting to a stage in the next couple of months that looks like more like a potential risk of overheating. Because we're lowering rates and because we're such looser financial conditions and because we're getting all this investment money.
And maybe a little tax stimulus too? What do you think?
Yeah, exactly. The big beautiful bill is a stimulus effect as well. So it all comes together. We're getting an overheated economy going into 26. That is more my worry, that then the Fed has to potentially shift course, even though there are many there that say rate cuts, we should continue with rate cuts.
Ben, always great to see you, especially on set. Thank you, sir. Well, stay tuned for our live coverage of Nvidia's second quarter earnings report starting at 4:15 p.m. Eastern, and you won't want to miss our interview with Nvidia CEO Jensen Huang. Tune in for that at 6:30 p.m. Eastern. Now time for some of today's trending tickers. Yahoo Finance's Brooke DePalma joining me here for a look at Cracker Barrel. We're going to start off on that name. That stock rising after the company bowed to calls from Trump and the public that it should never have scrapped that old logo. I also spoke to Marcus Collins, a professor of business marketing at the University of Michigan, and got his opinion and thoughts on what it would mean for the company if they did backtrack their logo decision. And here's what he had to say.
Look at Bud Light. When in the face of backlash and did their partnership with Dylan Mulvaney, the trans influencer, they got some pushback, and what did they do? They flinched. They flinched because they were like, hey, we don't want this smoke. And as a result, people who felt like they were being seen by Bud Light, they felt now alienated, and the people who were boycotting them didn't start drinking Bud Light now, so they're kind of left in this messy middle. My take is that Cracker Barrel made some decisions. And those decisions were based on insights. They're based on some knowledge that we don't have. They know their business better than we do. To revert back to the old will only get you back to the old. I don't think the people who are like, bring back the guy and bring back the barrel, that's going to make all the difference in the world.
Okay, but here's the thing, Brooke DePalma. They did ditch the new logo.
They did.
That sparked this firestorm. They caused a drop in the stock. Companies saying our new logo is going away and our old timer will remain. Of course, listen, it was the social media backlash, Brooke. Trump's weighing in. By the way, Trump weighing in, congratulate the company on that decision. Make your customers happy again, he said, Brooke.
Yeah, and that's exactly what they intend to do here. I mean, they brought back this logo, they brought back the barrel, they brought back the old timer who may or may not be Uncle Herschel, yep. And what we're hearing right now from the street is the stock is up on this. It's up about 8% going into the close. And this is largely because there's this optimism that, hey, it got lots of attention from this. So what we heard today from Citi analyst John Tower, he said that going into this hubbub around what has been this week-long controversy about their logo, well, they generally have a low consumer awareness base given versus their casual dining peers, given the brand footprint, the age, and the ad budget. They said, hey, maybe this could spark some curiosity for those customers who have been hearing so much about this logo controversy. Could they now go in? And he said in the note that this could spark curiosity and visits near term as consumers determine what all the ballyhoo was all about, he said in his note. He did say that searches for Cracker Barrel on the week hit a record high.
So you
lots
see,
of curiosity.
there's no such thing as bad press. That's how, is that the moral? I don't know. All right, another story we're looking at is the effect on stocks from Taylor Swift and Travis Kelce, one of the stocks being Ralph Lauren. Jeffrey's noting that Taylor Swift and Travis Kelce wearing Ralph Lauren in their engagement photos could be a catalyst. But other names that have also been getting traction from Taylor and Travis, American Eagle, Signet Jewelers. Here was how our friends at Barron's put it. They said it like this. They said, Brooke, Taylor Swift's engagement is a love story for American Eagle stock and Ralph Lauren and more. They note how American Eagle announced a limited edition collaboration with Kelce's True Colors sportswear brand just a day after the proposal. They point out both Swift and Kelce donned Ralph Lauren in the shoot for the Instagram post. The singer apparently wearing Cartier watch, Louis Vuitton sandals.
Yeah, and apparently this happened all after the podcast was filmed, which got so much attention. Now it's getting attention yet again, and investors, well, they're living for the hope of it all. Did you get that reference? Okay, he's a Swiftie, guys. But
Not really. I was just nodding along.
What we saw was 30 minutes after they announced this engagement yesterday, we saw the Ralph Lauren dress that Taylor Swift wore on the Instagram post completely sell out. The dress is worth $398. And the Jeffrey analyst said here that for a company that states that it's not only in the clothing business, but in the dreams business, we view this outcome as a mission success, supporting Ralph Lauren's brand and likely this continued momentum. Of course, American Eagle, that's going to be 2 launches of this collection with Travis Kelce. American Eagle, today, all the investors are saying, put aside the tariff news, put aside the Cindy Sweet campaign. We're focusing on the love story that is Taylor Swift.
And why
Travis
not?
Kelce.
Apparently, the Instagram post where they announced this engagement, something like 29 million likes and counting. Yeah. Wow.
It just goes to show the effect that they have. Also, we're seeing Signet Jewelers also get a pop on this news because who doesn't want to be engaged at the same time as Taylor Swift?
No, a love story.
It's a love story.
What's not to like? Lastly, Krispy Kreme getting a not-so-sweet downgrade at JP Morgan, that firm lowering its rating on the stock from neutral. They go to underweight. So JP Morgan, Brooke DePalma, they go to the effectively a sell. They're talking execution risks. They say the underlying business trends in the U.S. experience further declines. They did talk about potential benefits from maybe a strategic owner. Maybe that could unlock some value faster here. What do you make of it?
Yeah, I mean, certainly this has been quite the year for Krispy Kreme. We spoke to the CEO earlier this year when there was sort of this drop off in the stock price and the pressure that this company has gotten from investors. It seems like it's bad news after bad news. The company, or rather JP Morgan, saying in this note that they also highlighted that partnership with the McDonald's that ultimately now has ended. That was supposed to be a major moment for their Deliver Fresh Daily model. They were really going to ramp up production of that. Around that, they also noted that the people like to have these, glazed donuts fresh within, a certain amount of time that they come out of the oven. So backing off of the McDonald's partnership, they're a bit of a pullback with that Deliver Fresh Daily model. That's going to impact here. We also know that overall, just business trends here in the U.S. have been under pressure. This is a company that has largely been underperforming year to date, down more than 60%. Of course, keep in mind they IPO'd at $17. We're now at $3.58. So it'll be interesting to see what exactly this turnaround story goes. We know that they loaded off Insomnia cookies. Just lots to watch when it comes to this company.
Yeah, most on the street are at a hold. JP Morgan, though, go to sell. Thank you, Brooke. Coming up, the U.S. doubles tariffs on India. Will there be ways to soften the blow? We're going to have more on that story when we return. Stick with us. Trump hits India with 50% tariffs, doubling the 25% tariff rate as punishment for India buying Russian oil. Here with more on what this means for trade, we got Yahoo Finance Washington correspondent Ben Emons. Ben.
Yeah, good afternoon, Josh. So these are now the highest top-line tariff rates in all of Asia, and India is now equal to Brazil with 50% overall rates as the highest rates in the world. I'll start with the sort of sectors that are expected to be most immediately impacted by this. There's a bunch that aren't, but those that are manufactured goods are the top-line ones. A New Delhi-based think tank has looked into this and has isolated things like textiles, gems, jewelry, even shrimp as major exports that are from India to the U.S. They're now seeing much higher rates. So a lot of goods like that are being quickly downgraded in terms of coming to the U.S., but also shifting to other countries. That's the trend that's expected there. It's important to also note a lot of sectors that aren't impacted, at least so far. Tech is a major one there. iPhones, a lot of iPhone production for the American market has shifted to India in recent years. Those are still excluded for the moment. Trump is promising semiconductor-specific tariffs at some point in the months ahead that could change that calculation. But for now, a company like Apple didn't see a rate change yesterday to today. Another big one is pharmaceuticals. It's a similar situation. Pharma is waiting their own sector-specific tariffs. India, which is a big producer of generic drugs, is not included there. Another point that's important to note here is that service exports, which actually are the majority of India's exports to the U.S., are not affected. So phone banks, phone calls to India aren't changed there at all. Overall point here is that the effect is going to be notable, though, on the Indian economy. One estimate is about 1% off of India's growth rate from about 6.5% to 5.5% is what the Indian economy might be impacted here. But what they've made the calculation clearly is that at least for the time being, the costs of getting off of cheap Russian oil outweigh the cost of whatever the U.S. is going to throw at them, at least for now. That's where things stand at the moment.
And so, Ben, so what's next here then? What are the next steps in these talks?
Mm-hmm. Yeah, so the talks are ongoing. They've been remote for the last few weeks. The words that the Trump administration team is using today are words like unproductive and intransigent in terms of how this is going. So there's some back and forth clearly, but they're at a standstill. The larger context here, at least for these 25% additional tariffs, is that it's all tied up in the Russia-Ukraine war, obviously. And so the fate of those negotiations are going to be key, at least for these additional 25%. So I think for investors or importers looking at this, calls between Washington and New Delhi might be a little less important, at least for the next few days, than calls between New Delhi and Moscow, because even Trump officials are noting today these 25% additional tariffs are about kind of indirect pressure on Moscow. Whether that comes to fruition remains to be seen.
All right, thank you, Ben. Appreciate it. Coming up, the street waits with bated breath on what Nvidia earnings will mean going forward. We're taking a deep dive into those expectations when we return. Stay with us.
The street has been getting pretty bullish on Nvidia recently, right in time for Q2 earnings on Wednesday. Analysts have raised their price targets on the chipmaker by over 7% in the last month, as Luke Kawa notes on X. But critically, does Wall Street actually get Nvidia right? And that's our basic question to answer on today's Stocks in Translation. Now, first, a quick definition. A price target is an analyst's estimate of where a stock should trade over the next 12 months based on their models and assumptions. And as we noted, those targets have been rising for Nvidia recently. But first, we wanted to compare the increase over the last month to all of Nvidia's earnings releases over the last decade. Does it stand out? Well, this is what it looks like over the last 5 years. And notice the spike when the hype builds and the dips when analysts get cautious. As you can see, the recent revision higher shown in the last bar on the right here, pretty strong historically, especially for Q2 earnings released in August, which are the bars in white. Now next, we wanted to see how the stock price actually performs when Wall Street raises or lowers their price target in the month leading up to each earnings report. We find that you can group those analyst price targets into 3 buckets, which have very different outcomes for how Nvidia stock moves after the reporting. Now, in the first bucket, we put all the times that the street lowered their price targets, which happened 10 times over the last decade. In the second, we put all the times that analysts raised their price targets by up to 5%. And finally, we have all the times the street raised over 5%. This strongly bullish group was the most common outcome and happened 16 times. So that explains the 3 groups or clusters of bars that you're seeing. Now, within each of these 3 groups, we can see the median returns for various time frames following the earnings announcement, assuming that you bought right before the report each time. So the periods that we're showing here are 1 day later, 1 week, 1 month, and 1 quarter later. What you tend to see is that Wall Street gets it right over these time frames. To the left, when they're lowering their targets and a bit bearish, we often see weak or even negative returns until you get up to about the 1 quarter holding period, which is only about 7%. All the way to the right, that group, you can see some of the best returns for that very bullish group. Over 1 day, 1 week, and 1 month, you got about 5%. And then for 1 quarter, you got 23% historically. And right in the middle there, that slightly bullish bucket, that's where you mostly see returns in between the bearish and the very bullish groups, as you might expect. Next, we're showing just a 1-year holding time, and that's because the returns are so much higher, from 75% to 120%, that we just couldn't include them in the last chart. It just makes all the other period returns look tiny. And now we have a twist, because as you can see at the left, when price targets were cut going into earnings, that's that left bar, the long run results were the best. So bearish analyst moves led to the highest 1-year returns of all 3 groups. In other words, short-term pain led to long-term gain. And finally, in addition to looking at post-earnings stock returns, we can also look at the win rate. Here we're showing the percentage of time that the returns were positive, keeping with the same buckets and time frames, from 1 day to 1 year. The odds of winning largely match the results that we saw in the previous charts, which were showing returns. The big price target hikes generally came with the highest win rates. But once again, we get a surprise. If you only look at the long run, 1 year out, the best odds came when Wall Street was a little bit bearish, lowering their targets. So here's a summary of all our main findings. When the street is strongly raising Nvidia price targets in the month ahead of earnings, that's when you get the best stock returns after the release, if you're holding for 1 day, 1 week, 1 month, or 1 quarter. And if analysts cut their targets, so that's when you see weaker near-term performance on those same time frames. And here's the twist again, but you actually get the best 1-year returns when the street has been a little bit bearish, lowering those targets. So bottom line, when you take a look at that 7% price target raise that we've seen over the last month, the hype train is clearly boarding. And history doesn't have to repeat, but the odds favor bullish price action in the stock over the short and long terms. And tune into Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcast.
Stay tuned for our live coverage of Nvidia's second quarter earnings report starting at 4:15 p.m. Eastern. And you won't want to miss our interview with Nvidia CEO Jensen Huang. Tune in at 6:30 p.m. Eastern. Nvidia reporting second quarter earnings on Wednesday. The company is at the forefront of AI, which is dominating market performance. But a recent report from Citi highlights sectors outside of the AI trade where investors can look for opportunity, including fintech and wearable technology. We're navigating how to play outside of the AI sector with the Yahoo Finance playbook. Joining me now is Drew Pettit, U.S. equity strategist at Citi. Drew, it's good to see you. So when you were searching for these non-AI opportunities, Drew, what were you searching for? Can you walk me through your screen?
Yeah, so first and foremost, I was looking for something where investors can complete their portfolios. We get it. AI is and has been an amazing theme to be invested in. It's still one of our favorite themes. We don't think you can ignore it, but that's really just the growth side of your portfolio. You need some value exposure. You need some stuff to basically round out the portfolio. So first and foremost, I was looking for more value style stocks and themes that can complement AI and build out a well-rounded portfolio.
And so what came through that screen? It sounds like fintech and wearable tech, Drew?
Yeah, so these stuck out because, look, even if you are a value stock or a value theme, you're not cheap. And I always air quote cheap. But here you need good earnings follow through or an earnings growth inflection. You need solid quality metrics because, again, you're not cheap. So when fintech and wearable tech, so that's a lot of kind of healthcare devices, they stood out because they had really strong fundamentals and they weren't priced to perfection.
So if you're already overweight AI, how as an investor should you think about these kind of non-AI themes? How should they fit into your portfolio, Drew?
Yeah, it's funny. So thinking about the balance, I would say AI, even when you think about the S&P 500, it's probably about 50% of your portfolio, at least your U.S. equity portfolio. So these other themes attach around the outside of it or adjacent to it. So you should be looking at a pretty heavy weight, let's call it maybe half your weight of your US equity exposure in AI. The other half can go into these themes. They can go into broader areas like financials, utilities as well. I think it's a really nice way to kind of complement and blend everything together.
We talked about the valuation for what came through the screen, Drew. How did earnings growth look?
Yeah, so it's funny. For value, let's just start high level. Value, you're starting to see earnings growth inflect. For the next year, you should see earnings growth of almost 10%, but we don't have a lot of confidence in that actually being true because we've seen a lot of earnings downgrades for value as a whole. For fintech and wearable tech, we expect these to grow between kind of high single digits in the low teens. But the difference here is the revisions have actually been really stable. You haven't seen a lot of cuts to 2026 numbers. So you should see premium growth to the other half or the value side of the index. But again, not fully priced in.
Any specific names you'd highlight for us, Drew?
Yeah, it's funny. On fintech, we go back to some old school names that are kind of market leaders in integrating. So Capital One Financial, who just bought Discover Cards and so on, BlackRock, Charles Schwab, and then even someone who's tied to the mortgage market, Equifax, for example. I think those are really interesting fintech names, maybe not as techy as interesting as people think, but offer really good value, and our analysts have pretty strong conviction. On the wearable tech side, Boston Scientific and Medtronic, two different stories. Medtronic, more of a turnaround. Boston Scientific, basically the best in the space if you ask our analysts.
And I know this is a non-AI discussion, Drew, but in this report, did I see that, did you add Nvidia to your AI at a reasonable price basket?
It was in there before, and this is kind of the interesting story when you think about Nvidia tonight. It's not really about where the stock is priced or what's going on in the quarter. It's about the out years. And this is a stock, even though it keeps moving higher, the out year estimates for 2026, 2027 keep moving higher. So to us, we thought it was a really good time to add this to our portfolio because it hasn't been there this year.
Drew, finally, I was talking to a strategist on the show today, longtime market watcher like yourself, and I asked him, what is more important to the market now? I said, Drew, is it the Fed or is it the great AI trade and trend? He said the latter, but what do you think, Drew?
It's funny, if I had to pick between the two, I might agree and say the latter, but to us, it's the fundamentals in what AI and tech development and innovation means for company fundamentals. It's not just the tech companies that can benefit from this. We see AI permeating a lot of different industries, and it should show up in better margins, better productivity, better sales and earnings per employee. All of those enhancements really make the S&P 500 a structural winner. So yeah, between the two, I would pick AI and tech innovation as well.
Drew, always great to see you and to have you on the show. Thank you.
Yeah, thanks for having me.
Time now for what to watch Thursday, August 28th. We're going to start off on the earnings front. We're going to be getting another big batch of earnings on Thursday, including Dollar General, Dell, and Marvell. Dell announcing results for the second quarter after the markets close. Analysts expecting Dell to bring in about $7 billion from AI server sales in Q2 and getting a boost from the rollout of Nvidia's new Blackwell chips. That's expected to drive even more big AI orders for Dell. And moving over to housing, some fresh housing data coming in on Thursday with pending home sales. Economists forecasting sales to fall at an annualized rate of 0.2%, an improvement from June's drop of 0.8%, and signaling that the housing market is still cooling, but not as much as before. And taking a look at the Federal Reserve, we're going to be getting some more Fed commentary on Thursday, this time from Fed Governor Christopher Waller. This is coming against the backdrop of a contentious back and forth between President Trump and Fed Governor Lisa Cook. Trump trying to remove Cook from her position, and Cook expected to file a lawsuit over Trump's move, according to her attorney. While wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for our live coverage of Nvidia's second quarter earnings report that starts at 4:15 p.m. Eastern. And you won't want to miss our interview with CEO Jensen Huang. Tune in for that at 6:30 p.m. Eastern.